Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to this special edition of the Through the Noise podcast series. Well, it's been quite a week for financial markets, and I thought it was worth reaching out to share my latest thinking on recent developments and what it might mean for investors. A week ago, the world was bracing themselves for a re-acceleration of monetary policy tightening in the US and another 50 basis points rate hike in Europe. Now, markets are toying with the possibility that they might stand pat altogether, or at least only hike rates by 25 basis points apiece. So, what has changed? Well, to be honest, we've been arguing for some time that the pace of monetary policy tightening over the past 15 months dramatically increased the risk of something breaking in the financial system, and that is exactly what we've seen over the past week. Two regional US banks have effectively been forced to shutter their operations, and then, this week, Credit Suisse has come under significant pressure due to concerns about its financial position. To us, this merely increases our conviction that a US recession is in the works. We've been talking about our recession checklist for many months now, and this has increasingly gone from predominantly green to predominantly red over the course of the past year, with business confidence, inventory and consumer data all highlighting elevated recession risks. And of course, the inversion of the yield curve, whereby short-term interest rates moved above long-term bond yields, suggests, according to history at least, that a recession is just a matter of months away. Only the labour market has been an area of strength, although we believe that this strength is one, overstated, and two, starting to show signs of some cracks appearing. Finally, recent developments mean that banks will likely be even more reluctant to lend, which will merely act as a further brake on both the US and European economies. Now, the good news is that central banks and regulators have a huge incentive to get ahead of this and avoid contagion to different sectors and organisations, and the actions that they've already taken probably go a long way to addressing the known risks. However, the challenge is that the global financial system is so interconnected that how the situation will play out is very difficult to predict. This means that it will probably be fighting fires for a while longer until the situation stabilises. Meanwhile, central banks are still in a quandary from a macroeconomic perspective. So even after a year of rapid rate hikes, growth and inflation in the US and Europe have been more resilient than expected, with US job creation and consumer inflation for February beating expectations. As a result, as mentioned earlier, even until last week, central banks were very focused on subduing inflation rather than worrying about the impact of rising rates on growth. Now, following the recent challenges in the banking sector, we expect a slightly nuanced change coming through from central banks. So we expect the ECB to only hike rates by 25 basis points tonight instead of a 50 basis points hike signalled by ECB President Lagarde as recently as last week. And we also see a 60% probability of just a 25 basis point rate hike from the Fed next week, and actually even a 25% that the Fed pauses altogether. Again, this compares with market expectations of a 50 basis points US rate hike just last week after Fed Chair Powell's testimony to the US Congress. Post-meeting guidance from both Lagarde and Powell will be watched very, very closely by financial market participants to assess the extent to which financial stability issues will influence the policy stance going forward. So what do we recommend? Well, if anything, it makes us happier with our 2023 strategy of playing it safe. Within a foundation portfolio, we are underweight developed market equities and overweight high quality or investment grade bonds. We continue to favour assets in Asia due to the different stage of the economic cycle we are in here. Now, while China data this week was on the face of it nothing to get too excited about, we see growth accelerating in the coming months, in part due to the lagged effect of monetary policy stimulus and fiscal policy stimulus, but also due to the low base effects from the March to June period in 2022. Within equities, we're overweight Asia ex Japan, and within that, we're overweight China equities. We also favour Asia US dollar bonds, which are generally high quality and defensive in nature and should benefit from easing regulatory headwinds as well as an improving corporate profitability outlook. Well, that's all about all we have time for today, but please tune in again tomorrow to listen to my CIO office colleagues go through this in a bit more detail, which will include our latest thinking on the outlook for the banking sector globally. Thank you for listening, and please take care.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.